guys, Brian Stevens with Dave Stevens. Dave, let's just jump right into it. Now, there's a rule that the CFPB has proposed that I don't exactly understand, and I hope you can clarify it to me and my audience. But the proposed rule is that non-banks must publicly register with the CFPB when they use certain terms and conditions in form contracts. What exactly how does that apply?
Well, look, I think the short answer to this, Brian, is this is part of a steady drumbeat that we've been experiencing of concern from FHFA, from Ginnie Mae, from CFPB now on regulating non-banks. And so honestly, this just adds to the piling on effect that's occurring. But between increased capital requirements, the FHFA's even more recent rule about MSR valuations. I don't know if you saw that, but that's pretty important. Meaning I'm not going to take your word for it. I'm going to use my own formula if I'm to evaluate how you're booking your MSRs. To this rule from the Bureau, it's really just a wake-up call to independent mortgage bankers that the scrutiny is only increasing as we move forward here. So how the Bureau's rule is going to impact independent mortgage bankers, honestly, I'm not quite sure specifically, but I think the overall piling on effect that's happening here should have every independent mortgage banker concerned. I know they all have their trade associations, whether it's the MBA or CHLA or their state associations and more that represent them. But in my view, independent mortgage bankers need to be organized as an entity because the attack is coming at them pretty aggressively, and it's been steady coming from virtually all regulators. And as you know, there's also what was an effort under Director Calabria, the former head of the FHFA, to call independent mortgage bankers SIFIs, systemically important financial institutions. And so, this is a big deal. I think we haven't seen this wave of oversight of IMBs as a category ever in the history of mortgage banking.
Wow.
So this is really a first, not just from the Bureau again, it's the cumulative effect of all of these moves.
Now, we've seen a lot of the smaller independent mortgage bankers folding up shop right now or getting absorbed by some larger ones. Is this going to have even a larger effect on that, do you think? Just make it too difficult for the smaller independent mortgage banks to exist?
Yeah, I mean, I think for smaller independent, I hate to say this, I think there's a below the radar kind of benefit that small independent mortgage bankers have lived by, even since Dodd-Frank. You all get audited, they all get audited by their state regulators and their regular annual reviews wherever they do business and that kind of thing. But it's rare that the CFPB engages in a cease and desist or any kind of oversight when you're below a certain size as an IMB. That doesn't mean you should go out and go crazy on your LO comp plans and violate RESPA and or TRID and break the law across the board. But I think in a general sense that smaller independent mortgage bankers have been and probably will remain sheltered from the federal regulatory oversight in any significant way, simply because none of the federal agencies have the personnel to be able to go into that many companies. Remember, it's about 900 independent mortgage bankers in the United States. The CFPB just doesn't have the enforcement capability to go after all 900. They can focus on the top 50, maybe top 100, best case, along with the banks, and credit unions, everybody else they have to see as well.
I wasn't going to ask this question, but since you said that, I kind of want to now. The moves that Wells Fargo has just made, getting out of correspondent, getting out of lending, saying we're going to focus on minority loans only. Is that them just crying uncle with all the enforcement actions that have been taken against them over the past couple of years? It seems
it's funny.
Whenever the CFPB needs a win, they go to Wells Fargo.
I just did a pretty long interview yesterday with one of the trade periodicals that I assume will come out here in the next couple of days on this exact subject. And I think crying uncle, I think it's Wells Fargo saying risk reward benefit for being in the mortgage business just doesn't add up, especially in the contraction of the market that's occurring right now. And so their exodus does not surprise me one bit. I suspected it, months ago when they first announced that they were going to, be contracting in some way, shape, or form. I was just waiting for the correspondent channel to close down. I think we'll see some MSR sales from them as they probably try to sell off, first and foremost, a chunk of their Ginnie Mae book. But yeah, I mean, Wells is doing what a lot of other banks have done. They're not the only one. Is they already were de-emphasizing the Ginnie Mae programs, but now I think what they'll be a retail originator to serve their own customers, bank customers, and private bank customers, and they're going to double down on affordable lending, as we all know, with their announced program. And yeah, they're clearly saying after the big bank settlement and then subsequent class action cases and Elizabeth Warren coming after every CEO that's been in that seat and more, the equation doesn't work to stay in mortgages. And they've had a target on their back. There's no question about it. Some of it may be deserved. Some of it, I think, is just because of their size. And I think it's an unfortunate outcome for all of us in the mortgage business because vast majority of lenders in this country depended on Wells for correspondent lending, at least for some part of their business.
But I just saw, our credit scores with Ginnie and the GSEs are still above 700 on average. Nearly 60% of all loans from the GSEs and Ginnie have a DTI under 43, and prices are up 115%. Are they still making it too hard to get a loan to qualify for people? Do they need to kind of loosen their guidelines a little bit?
That's the challenge. Freddie and Fannie just, as you know, announced the program where they're waiving LLPAs for first-time home buyers below a certain AMI. And that's a big move. But I wonder whether that's going to really move the dial, because if you look at where loans are being originated right now, 80% of all first-time home buyers are still going to the FHA. 2/3 of African Americans are still getting their loan through a Ginnie Mae program. Roughly the same for Latinos in this country. That comes down to FICO and DTI. Really, that's where the floors are. And the banks have a higher threshold, as you know, when it comes to overlays. The institution's more likely to have lower minimum FICOs are non-banks, and the ones more likely to have higher minimum FICOs are the banks. So Wells has said with their minority lending effort that they're going to avoid it. It won't be an FHA program. It's going to be their own, I assume, portfolio program, or maybe something could go into a private label security at some point. But and it may have value as a PLS because it could be considered almost specified pool-like, because they'll probably have very low prepayment speeds. But nevertheless, all that being said, I think it's going to be, that's really where the challenges are. We have an inventory challenge for minority, not just minority, for first-time home buyers. FICO minimums are lower for minorities. When I was FHA commissioner, guys, I put in the 580 floor. There never was a floor with FICO at FHA. I put in the 580 when I was commissioner, before which you have to put 10% down. And then I had a 500 floor after that. But I did that because a lot of big banks wanted me to go at 620 or 640, but we did an analysis of the population of borrowers in the FHA program, and there are a lot of minorities in the 580 to 620 bucket. And the reason is that, you can't lump all minorities together, but we have a lot of Latinos who come from countries previously through their family history where banks were not trusted. We have a lot of minorities who don't understand how to build credit and how you need probably multiple sources of credit that are publicly disclosed through credit reporting agencies, and you have to have a history with low leverage on those multiple sources in order to get your FICO above 700. And that education doesn't naturally exist, and it certainly doesn't exist for those who haven't had the educational opportunities or access to the financial system like others have, and that tends to focus more on minorities. And so you'll see, less banked, less credit, fewer credit histories, fewer sources of credit, fewer credit lines, whether it's credit cards or auto loans or whatever it may be. And so all of that depresses the credit scores. First-time homebuyers in this country all across the board have lower credit scores anyway, but it only gets worse depending on how you built your credit. So to your question, will the floors of FICO that some of these lenders have reduce their ability to meet their objectives to build minority business? Absolutely. As will inventory shortages, but there's no question about that.
Yeah, and that's kind of to my point, is when you look at the 700 plus credit score, and when you look at the DTI issues, which that's going to be an income issue, which is also going to disproportionately affect minorities. And then when you look at home ownership rates, and we really haven't moved the dial for decades with minorities, are we failing? Are we failing in our mission, our mission goal to help minorities and raise home ownership levels? What do we need to do differently in order to move the dial?
Yes, we're failing. I'm literally just working with a team on the fine finishes of a deck, which we're going to bring up to Capitol Hill, my group, which includes Republican and Democratic lobbyists and a comms team and more. But we're going to go around the Hill and have appointments with as many members of the House Financial Services and Senate Banking Committee in particular, talking about this exact subject, because home ownership rates have actually dropped over the last couple of years for minorities. Even Hispanics, which had been increasing, have dropped, and in the last year, and African Americans as well. We have home ownership rates that have shown no improvement for over 4 decades for Blacks in this country. And the reality is that traditional risk-based underwriting standards, like the GSEs have, tend to price out those on the margin. And unfortunately, due to lack of inherited wealth, which is really prominent in the African American community, lower credit scores, and more, we have a whole segment of borrowers who not only can they not find an affordable first-time home that they can afford. Yes, their wages are suppressed, so you're going to have a fewer percentage of them that actually would meet a qualification standard, no matter how limited it was. Not all of them, but there'll be fewer as a percentage compared to white non-Hispanics who make higher wages, just a matter of factual data. But for that borrower population who could potentially buy a home, who could come up with the down payment or get a down payment assistance program, the combination of supply, credit score limitations, lack of consideration of other income sources like renters or another person living in a home who's got an income but's not on the mortgage, like a family member, a parent, or whoever lives with you. All of these things that don't fit into a square peg, square hole underwriting philosophy means that people on the margin are just not going to get access to home ownership. And that, unfortunately, has a disparate impact. It impacts minorities. It impacts first-time home buyers. But today, 2/3 of all if you look at household formation, 2/3 of all households being formed today are not white, non-Hispanic. In other words, 2/3 of all new households being formed today in this country are minority. Household formation is rental and owned. But we've got a huge problem to overcome here. And the GSEs are trying with the LLPA waiver. I think we'll find out that's sort of underwhelming. And unfortunately, we have no response to the inventory crisis. So
can't we hold the new home builders accountable and force them into building new homes? New affordable.
Well, you could try to force them. There's a carrot and a stick approach. There's a piece put out by Harvard, the Joint Center for Housing Studies, which I just read about. It's published right now. You can pull it up on their website. I just got the email on it. But it talks about the demographic demand coming in for household formation. And one of the things they suggest, and this comes from a bunch of academics at Harvard, is the entry point to build a home the cost has gotten extraordinarily high between environmental studies, all the challenges of being able to acquire and build on land in a lot of communities in this country. That time from land acquisition to disposition of an individual home at settlement has gotten so much longer, and the margins have gotten so much tighter that the economics just don't reward home builders who build affordable housing. So the only way you end up doing it is certain communities like in New Orleans and elsewhere, they put zoning requirements for new builders that if you're going to build X number of homes, X percent has to be affordable. And that's how they end up getting there. But that's not commonly applied across all markets in this country. And I think we have to also look at the disincentives for builders to come into the market and build more affordable lending. Because if you can't get enough margin on an entry-level home, given the timeline associated with it and the costs involved, you're going to go build something bigger given all the demand that's in the market.
I think I just saw something that said 68% of contracts on new homes are being broken right now, and it was 13% last year. So that's only going to encourage them to not build any more houses. All right, my last question here is, speaking of it,
I will say, Brian, I will say there's just one point.
Yeah.
Home builders are being applauded right now for not overbuilding. Prior to the Great Recession of 2008, they overbuilt, and we had a lot of spec housing for sale, and that just led to the supply glut that we had in the marketplace. I mean, the other side of the shoe here that is home builders stopped building, really slowed down with this increase in rates and the slowdown in the market. And they haven't created an oversupply, which is going to put a cushion on home prices, at least for existing homeowners. They don't have to worry about their home prices dropping pretty dramatically. So it's such a double-edged sword here with so many complexities as you think about it.
Yeah, whenever I go somewhere, I always look at what the cost, like, what would it cost to own a house, your average house? Could a civil servant buy a house in the community that they serve? 10 years ago, 20 years ago, the answer was it's expensive. But yes, we are so far beyond that right now, where your civil servant can't buy a house in the community that they service. I mean, the numbers are ridiculous. I think something has to be done. I've seen like 3.5 million to 5 million home shortages that we have right now. The problem is if you build 5 million homes, it's going to bring all the prices down on homes. People don't want to have that either.
Well, there's other alternatives, by the way. You can use federal funds to subsidize a down payment program for first-time home buyers, like Maxine Waters tried to do in the House. You could use public funds to finance a long-term buy down for first-time home buyers only. So they get a 1 or 2% 30-year discount on their mortgage rate. And that's something that Senator Mark Warner and folks in the Senate Banking Committee tried to do, and it didn't go through. And so there are subsidy programs that you could improve affordability overall. But yeah, to your point, we have a supply problem and we have an access to credit problem. And both of those are in tandem happening at the same time. Right. And so there's no short-term solution here.
Okay, my last question. Home builder sentiment is up. I find that, I just find that funny. Anyways, home builder sentiment is up. Loan applications are up 26%. Rates are going down right now. Inflation seems to be trending down. Have we seen the worst of it? Have we gotten over the summit?
Yes.
Okay, good.
Let me put it this way. I just gave a big presentation literally just before getting on with you to about 300 realtors in the Midwest on behalf of a big lender who's a client of mine. And what was interesting in that presentation is I got fresh data from Dr. Mark Zandi, the chief economist at Moody's Analytics. I got great data from Mike Frantantoni, the chief economist at the Mortgage Bankers Association, and a few others that helped contribute from First American. I got Fannie Mae, et cetera, with their data. And everybody's saying the same thing. One is 30-year mortgages the spread over the 10-year is just way wide. They should be 100 basis points tighter than they are right now, roughly. And so that puts rates solidly in the mid fives to low fives, right? 30-year fixed rate right now is roughly about 6. We're having a pretty good day in the bond markets today. So, all that to be said is rates are going to come down. The Fed's going to stop tightening. Maybe they need another report or two, but the Fed always overcorrects. And I have a slide on the Federal Reserve funds rate going back to 1955. They always overcorrect. Every single time they've tightened markets, it always leads to a recession. There's been 10 recessions since 1955. And the Fed's responsible for every one of those. And they'll put us in one this time. But it'll be shallow. And mark my words, the moment Powell indicates that he's done tightening, rates are going to have a big rally. The stock market's also going to rally immediately. And home buyers are going to start coming out once they see rates solidly in the mid fives to buy homes. And then we're back to the core basics of demographic demand, which is huge right now and going to be huge for the next several years, unlike anything we've seen in the history of this country. When you look at the distribution of Americans by age right now in the United States, we have this big wave, big bubble right at about age 34 and for the next several years coming into their peak first-time home buying year. And so, I think we're going to, as we go into the second half of the year, we're going to see a continued growth in purchases. And if you believe the MBA or NAR, they expect even greater purchase years in 2024 and 2025. So it's going to be an interesting time. Your home builder sentiment data point you just threw out, that's coming off of a big low. It's still way down from a year ago, but yes, it popped just a little bit this last report from the home builders. So it is interesting how we look at perspective, because we can use short-term changes to be, really negative and freak us out. Like people say, home for sale inventory increased X% over a month ago. Well, yeah, but still, if you look at it compared to the last 20 years, we're at near historic lows for inventory for sale in the marketplace. So short-term changes, long-term changes, you have to have all the data to be able to understand that we have a supply shortage. We have huge demographic wave of demand coming our way. The moment Powell's done tightening, the rate improvements we've already seen off the 7% highs will only continue. And I think Frat and Tony's view that we'll be in the low fives by the end of the year and the fours the following year is probably realistic. I've seen another economist, I won't name him by name, but he's a well-known economist, thinks we'll be at 4.5 by the end of the year. Wow. So all that to be said is, yeah, I think the worst is over, but we're still going to have a horrible first quarter. We still don't have a refi boom. So you're never going to go back to 2021.
Right.
We still need a lot more consolidation in the mortgage space to get to right size ourselves so we can get not only volume, but margin in our business. But yeah, I think just generally speaking for the housing market and looking ahead, I'm much more bullish on the forward-looking view than where we've been in Q4 and where we are right now in Q1.
I like the home builder sentiment. I looked at it. How moody are they today? Well, the home builders are not very moody today. Well, that's nice to know.
Exactly. I love sentiment surveys because you go, how do you feel today? Fannie Mae does one. It's a home buyers, a consumer home buyers survey, a sentiment survey, and it's what percentage of Americans want to own a home, and it still runs very high. But then, what's the sentiment about buying a home right now? And it's still very low.
Only 26% right now, Dave. I just looked at it. Only
yes,
26%.
exactly.
Good time to buy a house. Hey, listen, thank you so much. I hope you feel better. I saw the Chairman Powell. Did you give the COVID to Chairman Powell?
There you go. Absolutely. I was funny because I've been fighting this here at home, but yeah. I saw from the Golden Globes, a lot of people didn't make whatever the next award ceremony, the Critics' Choice Awards, because so many of them had been at the Golden Globes and COVID was rampant at the Golden Globes. So a lot of people didn't go to the Critics' Choice Awards.
Hey,
so
by the way,
stay careful.
If you haven't seen it, go watch that movie. It's called like Anything, Everything, All the Time. Or have you seen that?
Oh yeah. No, I haven't seen it yet.
Oh my God. It's you have to watch. You have to stick with it. You got to watch the whole thing. It's the craziest movie you've ever seen, and I think it's brilliant.
Oh, great.
Seriously. It's wonderful.
Oh, that's my agenda for tonight.
Right on.
All right,
Dave,
dude.
you have a great day.
Take care, Brian.
Thanks.
Okay, you too.
Bye-bye.